thank you all for attending this the webinar. My name is Monty Silver. I'm a U.S. tax attorney living in Israel, and I've been a tax attorney for 20 years, exclusively a U.S. tax attorney. I used to work for the estate and gift tax. That's where I started, at the U.S. IRS Estate and Gift Tax Division of the IRS in Boston, and afterwards for the U.S. Tax Court, Judge Namaroff. And today we'll actually be reviewing a very important tax ruling of the tax court. So it'll be sort of a little bit of memory lane for me. I used to draft and write published opinions for Judge Namaroff. I was his law clerk. And a little bit about what I do is I provide services mainly or only to people who have U.S. tax issues. That is divided into two groups. That's non-Americans living outside of America, and that means people who are investing in the United States or people that have businesses in the United States. People who are investing can be Israelis, French, Italians, British, it doesn't matter, who are investing in United States real estate and securities predominantly. Or it can be people, as I said, who are conducting business in the United States and need assistance when it comes to things like generational transfer of significantly sized businesses, family businesses. The transfer involves gifts many times, so there's gift tax issues involved. There's the high corporate tax in the United States, so addressing that and how to invest or do business to deal with that. And of course, the main subjects are estate and gift and the high corporate tax rates of the United States. For U.S. citizens, it's people living outside the United States predominantly, and that are high wealth individuals, and they're looking to give up long-term green cards or citizenship. So that's what I do for a living. The reason I'm having this web seminar, other than the fact that I like to sort of convey information, hopefully in an understandable way, is because the U.S. law is similar for Israelis, for English, for Germans, for Italians, for people in Singapore, Spain. All those countries are present today online. And so there's no reason really for me just to focus on where I live in Israel and offer solutions to people locally. And I'm looking to expand. And the people who are in attendance today, you have clients that are in need of these kind of services if they're investing in the United States or doing business there. And hopefully we'll be able to find a way to work together. The other reason, and this is particularly relevant to you, is I travel a lot in Europe, and I'm more than happy to see how we can work together to identify Americans that are in need of these kind of services, even if they're not your clients, and to do joint marketing, to put on seminars, and to allow you to expand your reach in serving these kind of clients, because in everything I do, there's a local component, a non-U.S. component. If it's a British person or a French person who's thinking of investing in the United States or has investments and is afraid of estate tax, all these solutions have an American component and a local component. It's impossible to solve a problem without also addressing the local component of the country where you live. So again, I'm happy to convey this information to you today, but please feel free to contact me if you think that there are ways that we can generate value to people out there in your local markets. Okay, Having said that, we will now start with the presentation. Okay, I've been told by one person to try to shut the shades, but it's the best we can do, so we will begin. So anyways, what the agenda is today is to discuss a certain tax court ruling which was issued by the tax court in the United States about 2 months ago on July 13th, if I'm not mistaken. So it's less than 2 months ago. And the tax court in America is the court that hears federal tax disputes between taxpayers and the government. This specific case is significant because, for one, it took the court 3 years from the day of the hearing to render a decision. And we'll talk about why that is. It's a very significant ruling for non-Americans living outside the United States. So people who are active in business or in investments in your country, this ruling will impact them. So we will discuss the facts of the case, a legal analysis, and the implications in terms of the different kinds of taxes. That's capital gains and real estate. FIRPTA is the Foreign Investment in Real Property Act, the federal law in America governing foreigners investing in real estate. It has implications on estate tax and also on the gains of income and other kinds of profits like promote or bonuses. And then we will have a case study that one of you, that we will go through to apply the facts and the law to see how we can analyze this, the court ruling, and to sort of solidify and get those wheels of analysis in order, because I'd like to bring this home as much as possible. So when we're talking about this, I would also like you to vision people, real people and real situations, not to have this abstract. Think about a person in your country who's investing in America or who has an American investment. Think if you're a partner, a professional, a lawyer, an accountant, a tax professional. Think of someone who has is part of a partnership where there's an American involved. It can be accountants or lawyers who are active in 2 different countries, because this will apply in those very concrete situations. I really want to make this concrete, not abstract, because this will directly impact the bottom line of definitive groups of people, okay? And of course, the webinar is not legal advice. As you will see, it's kind of dense. I'm trying to make it as light as possible. And okay, so the facts of the case are really quite simple. Grecian is the name of the corporation, Grecian Magnesite Mining. It's a Greek company, and this is the facts of the case, that bought 12.5% of an American LLC. The LLC was involved in mining. It was based in America. It was an American company. But the Greek company itself had no connection to the United States. So it had no offices, no workers, no business. And at a certain stage, the Greek company sold its shares in the LLC for a significant profit. And the question was very simple. How does the U.S. tax that capital gain arising from the profit from the sale? Or more specifically, was the sale of the partnership interest, an LLC is deemed a partnership in this case and in many cases, so was the sale of a partnership interest by a non-U.S. person, in this case a corporation, subject to U.S. capital gains tax? The question, pretty simple, which is why it took 3 years for the court to reach a decision, because of the simplicity, this kind of transaction happens all the time. So think about, we'll take out the word Greek and put in British, France, Italy, or wherever you're located, and just substitute that to make it very clear to you that we're talking about people in your country, okay? And the implications of the ruling were very significant. As you know, corporate tax in America is 35%, 34, 35 plus state tax. So if this was subject to tax, the tax rate would have been 42% in the United States, or 0 as the case was decided. So the significance is, we're not talking about theory here, we're talking about significant cash. Okay, so this is something I just put in to allow us to examine the flow of the logic. We're talking about a case which was, oh, sorry about that, which is at the intersection between partnership law and non-resident tax law, meaning how the United States taxes non-residents. So just look at this flow chart and you'll see 3 columns. So first of all, what we will do in this analysis is we will go through 3 different columns. The first one is how U.S. taxes non-residents. The next one is how U.S. views and taxes partnerships. And then combining those 2 will give us the third, which we'll talk about later. So we'll start with the non-resident. As we shall see, there's 2 kinds of taxes that a non-resident, there's 2 situations in which an American, there's 2 types of situations where a non-resident is taxed in America. There's passive income, FDAP income, which includes taxes on U.S. sourced interest, dividends, rents, royalties. That's foreign, that's fixed and periodic income. And that's taxable if it's U.S. source. If I'm getting interest from a bond of IBM, it's taxable, okay? And it's taxable usually at the rate set forth in the treaties between the 2 countries, okay? So there's no question that FDAP, passive income, sourced in America, is taxable. The other area that's taxable for non-residents is if you have a business in the United States, then the ECI, the effectively connected income from the from the business, is taxable in the United States. So you need a trade or business in the United States and income which is effectively connected to that business. Just a break, you will be getting this presentation in the mail. There's no use to worry, it'll be coming to all people. I have your emails and I'll be happy to share it with you. Okay? So the question is income of a business effectively connected or not? And to know that, we have to know what type of income and the source. We'll talk about that. I'm just going through the very high level now. The second column is partnerships. Are we talking about a partnership? If no, then we're talking about something else. If yes, is it a sale of an interest of that partnership? If it's not, then it's not a capital gain and it's not the subject of today's ruling. If it is, then we will go through the maneuvers. But as you see here, we're talking about the intersection of 2 areas of law, non-resident and partnership. Okay, so now we will go to the analysis of the court in this specific case. We'll start with the non-resident tax. As I said, when is a foreign company or person subject to U.S. tax? As I said, there's the FDAP income, but FDAP does not include capital gains under Section 881 or 871. So the IRS, in this case, argued that we're talking about a U.S. trade or business because there was a mining business here. Okay, we're talking about a mining business which was taking place in America, and the IRS said not only is there a business here, but the income, the capital gains that the Greek company derived was effectively connected to that business, and therefore it's taxable under Section 882 or 871 of the code. So going back to this, what we see here is the IRS was saying, we're not talking about FDAP, we're talking about effectively connected income. Okay, that's the argument. That was the beginning of the IRS's argument. Okay, now so now we'll go to the partnership side of it. We're talking about a sale of a partnership interest, and the sale, a partnership interest under Section 741 of the code states that a partnership interest is a capital asset, and therefore the sale of that is capital gains. So we are talking about capital gain here. If the partnership would have sold, if the partner would have sold inventory, we would have maybe not be talking about a capital asset or a capital gain, but we're talking about the sale of a partnership interest. Okay, first of all. Secondly, a partner is deemed to be conducting a U.S. trade or business if the partnership is here, the U.S. company, the LLC, was involved in a business in the United States. They're a mining business, okay? So the Greek company could not say that it was not involved in a trade or business, because in real estate or in any other kind of partnership activity, if the partnership is involved in a business, the partner, any partner, it can be someone who's never been to the United States, doesn't know America, that person has a 0.5% share of the LLC or the partnership, but that person will be deemed to be a partner. So the partner is involved in the U.S. trade or business. So as you see, it'll all come down to whether the gain is effectively connected to that trade or business. Okay? So up until this ruling, the IRS had always maintained in its Revenue Rule 9132 that all gains from the sale of the partnership interest is U.S. source income and effectively connected income. That was the default rule. It had never been legislated by the Congress. It had never been adopted by the Department of Treasury in regulations. It was IRS interpretation, which, as a matter of law, is not law. It's an interpretation of the law. But that interpretation, for those of you that have ever dealt with U.S. tax issues, the trade or business stance of the IRS in this revenue rule created a significant burden for people planning to avoid estate tax or capital gains, because the position was that if it's connected to a bit trade or business in America, it's U.S. source and effectively connected. Okay? So the court looked at this argument of the IRS and said, you know what? You, IRS, you are an interpretive branch, which is not it's not law. That's your interpretation. Probably the same in any of your countries. So let us apply our thought to whether the sale of a partnership interest is indeed capital gain. Okay? So first of all, we're going to look and see what is being sold. The IRS, as I said in 9132, said that when a partnership is sold, an interest is sold, the partner sells every single item that's held in that partnership, meaning it took on an aggregate approach. When the partnership's interest was sold, the partner, in essence, was selling a bit of the telephone system, a bit of the business, a bit of the building, a bit of the pencil, everything in that business. The partner was selling its percentage. Okay, now that percentage, or that pen, or that phone is not a capital asset, it's inventory of the business. And that, the IRS argued, is not a capital asset. So therefore, therefore tax applied. Now, so the court looks at that and says, wait, let's look at FIRPTA, which is the U.S. Real estate law, and it says there in section 897G, which deals with partnerships investing in foreign partnerships investing, it's called special rule, that when a partnership sells, or when a partner sells its partnership interest, it'll be deemed a sale of that specific asset in the partnership. Meaning if the partnership holds 50,000 things, but one piece of real estate, then the sale of that partnership interest as to that real estate is deemed a sale. Only as to that piece of real estate, okay? But it says in the title of that law, special rule. So the court says, wait, if the special rule for real estate is called a special rule, that when you sell your partnership interest, you're selling that specific asset. If that's called special rule, then what is the general rule? Okay? So the court looked at that at length and said, if that's a special rule, then the exception, then the general rule obviously must be that when you're selling your partnership interest, you do not look into the partnership the partnership, but the partner is actually deemed to be selling the partnership interest, which is called the entity approach. The partner is not holding bits and pieces of every asset, but is holding the aggregate, the entity is holding shares, an undividable, separate ownership compared to the assets, other than in real estate. Real estate is a special rule. Okay, the court also recognized that in IRC 731, the gain from the sale of an interest is not individual items of a partnership, but the asset itself, okay? So when looking at these and other factors, the court concluded that, for the first time ever, that an entity, and this is a very important ruling because it will affect estate tax as well, as we will see, the partnership is an entity. It's not assets, it's a sale of an indivisible capital asset of personal property. So we're talking about the sale that in partnership law, when a foreigner sells its interest in a partnership, it's deemed a sale of the partnership interest and not the assets. Why is this important? Because under U.S. sourcing law, the sale of personal property by a non-resident is not U.S. source. So what we're talking about here is the Greek company sold something, a personal property, and this gain is Greek sourced. So you're living wherever you're living, and you're asking yourself, wait, if I sell something here in my country, if I sell this pen or I sell this mobile phone in my country, it's personal property. And I'm not an American, I'm a simple Italian, German, French, English. Why should this sale be taxed in the United States? No reason, obviously. So the court therefore concluded for the first section of the analysis that the general rule is that the sale of a partnership interest is generally not subject to gain in the capital gains in the United States, even if it's conducting a U.S. business. Okay? So that's a very significant ruling, because that means a lot of people can structure their activities or joint ventures in the U.S. and avoid estate tax, capital gains tax on that sale, okay? Now, we're talking about capital gains here, not estate tax. The court only addressed capital gains, okay? So we've reached a state in the analysis. Let me just go back so you see. We are now going into, we've talked about non-resident, we've talked about the partnership. Now we'll go to the exception, the third column, okay? So the third column has to do with how the IRS sought to counter that. They lost stage one. It's not taxable, but they said, hold on. There is, in section 865E, an exception to the rule, and which says this: if a non-resident maintains an office in the United States, income from the sale of the property, including inventory, is attributable to, which is attributable to such office, is U.S. source. Okay, so they're saying that's fine. It's the general rule is that we won't tax you. It's foreign source, and we've already seen that the sale of the partnership is foreign source. But there's a special rule that says that if the person is conducting has an office in the United States and sells personal property, then that is deemed U.S. source if it's attributable to that office. Now we understand, that we can conceptually understand why. Imagine I'm Monty. I've been representing a U.S. law firm here in Israel up until last year for many years, and I'm sitting here in Israel and I'm doing work for that law firm in America, and they're giving me work. And I go over there a lot, and I'm using their LexisNexis and their Westlaw, and I'm using their databases, and I'm using the partners there. They're helping me now, and I'm earning money from the work. I'm earning services from what I work. Now, should I be taxed on this by the United States? Well, if I'm in essence maintaining an office over there, and I sell my partnership interest. I sell personal property, my partnership interest, let's say, for a gain, and a lot of my income or a lot of the profit is coming from the United States, the IRS can say, yes, you know what, Monty, true, you're selling it abroad in Europe or in Israel, but it's really American sourced because you've been representing a U.S. partnership in Israel, and a lot of the core of what you've been earning is based in the United States. So we're going to tax you on that capital gain. That was the IRS way to get around the initial loss. Okay? I'll take a short break. I see that there's some chats here. Let me just see if there's any questions. Okay, I see that there are some questions here. Or there's a question when I take questions. Feel free to submit questions if I want to stop, and if I see that I should stop in the middle, something is not clear. I'll be very happy to answer them as we go. So I'll take a 10-second breather here. I'll drink a glass of water. And let me know if there's any questions. I don't see any coming in right now. I do see, though, all kinds of people from really around the world. I'm very happy that there's so many people from even in Asia, Hong Kong, Singapore, and many from Europe. Very nice. Okay, so we'll continue. So we were talking about, just to go back, the IRS's way to get around the fact that this was foreign source, just like me selling this iPhone or phone. And the rule says that the rule that the IRS referred to says that if it's U.S. source, if it's effectively connected, if my gain of the sale of the partnership is effectively connected to a U.S. business, it's U.S. source and therefore taxable. Okay, so the court looked at that, but that rule specifically states the following: that it is taxable only if the U.S. office is a material factor in the production of the capital gain, and the U.S. office regularly carries on the activities of the type which generated the gain. Okay, so these are very, very nebulous, unclear terms, what does material factor mean, and what does regularly carries on the activities, which are the type of the gain. This is what us tax people make a living on, as you know. They're very vague concepts. But if those two facts are met, those two elements are met, then the court says yes, it is subject to capital gains. But let's talk about what we're seeing here. So the court now goes to this corporation, this mining company, and looks at the different kinds of income it's generating. The mining company generates profits on a yearly basis from the operation, from the regular business. Okay, so we have income generated from the business. Okay, obviously that income is based on the material work of the office, and it's produced by the work of the operating company, and the operating income obviously is connected to the regular business of the mining, because it's income which is generated from the actual business, the day-to-day business. That's the income, the operating income. So the court said yes, there, no doubt, it's taxable. But what about capital gains? Okay, and this is an amazing distinction here that makes us tax people laugh and sort of wonder. The court said this gain, the capital gain, is not generated in the regular course of the business. The court specifically says, okay, true, Mr. Mining Company, you are doing your best to generate a good business, to increase the business, to make more profits, to hire more people. That's operating, that's what you do on an operating basis, okay? The fact that the business increased in value, that's not directly related to what you do on a regular basis. You're not in the business of increasing the value of the part of the business. You're in the business of generating a profit on an operating basis. Okay? So therefore, Mr. IRS, you cannot tax this gain because the increase in value is secondary and not directly related to what you do on a day-to-day basis. Now, you may say that's spreading hairs or something like that, but that's what the court ruled, that the business is not related. The business is not related to, directly related to raise your, to generate income. I see someone raise their hand. I'm not sure how to address that here. What I suggest is that you just chat your question or your comment, and we can take it from there. Okay. So when would the day-to-day business be regular enough and connected enough to the capital gain? Okay, so the code, the tax code says that in order for the business to be deemed regularly carrying on the type of business or activities that justify the gain, that business has to actually participate in the negotiation, soliciting, or performing activities that are related to the type of income at question. Okay? No one is doubting that for the income tax, not the capital gains tax, the business was soliciting, negotiating, performing activities required to generate the income tax. But not so to the capital gain, because the business was not in the business of buying and selling partnership shares. This event, the buying of the partnership interest from the Greek, was actually called an extraordinary event. Of course it's an extraordinary event. When a partnership buys out a partner or a partnership deal, that's an extraordinary event. If the company had been in the business of buying and selling, buying and selling, buying and selling partnership interests, like the court said, then yes, then it would have been, the capital gain would have arisen from the regular business of buying and selling a partnership interest. But that was not the case here. Therefore, no gain as applied to the capital gains. So the conclusion is that the gain from the sale of an interest in an LLC partnership by a non-resident is not generally subject to U.S. capital gains law. The exception is FIRPTA, the real estate, and also the material factor plus regularity carries on what we talked about. The court did not even address treaty protections. Each one of you live in a country where most of you live where there's a treaty between the United States and your country. The court said here, listen, we're not even going to address the additional protections of the treaty because we're talking about under U.S. tax law. Under U.S. tax law, there's no tax, so we don't even have to get into the treaty analysis. Okay? A question here is whether the states need to abide by this or it's up to each state to agree. First of all, no, this is a federal tax. We're talking about federal tax here. So the states have no bearing on the federal tax, only on state tax. This is a federal issue. So the court didn't even get to the issue of issues of permanent establishment or sourcing under the treaty. Okay, the most important issue I would think to many of you has to do with the state tax. True, some people, I know people that are active in U.S. Businesses as partners. This can be lawyers. This can be financial VCs. An Israeli here who is a partner in a VC in the United States and goes back and forth and promotes the startups. So it is, it happens, in Israel more so than not because of the venture capital community. But the vast, vast majority of these matters arise in regard to people investing in U.S. real estate or stocks. Why is that? Okay, so why does this case impact that? The case does not deal at all with the state tax, okay? But as you know or may not know, any non-American investing in American stocks or real estate who passes away owning more than $60,000 of such assets are subject to an estate tax, of between 30 and 40% for any significant amount of the value at death, okay? So what does this estate tax involve? U.S. real estate and securities of U.S. corporations. So if a person holds U.S. real estate or securities at death and it's more than $60,000, that person will be liable for up to 40% of the value of those assets, okay? So many people hold real estate, invest in real estate in LLCs. I know I'm invested. Many people I represent are invested in LLCs. We saw from the tax court that an LLC is a partnership. So the question is whether a person who passes away holding real estate in a partnership is subject to a state tax. Okay, and that's a very important question because a lot of people, I'm sure you know, are investing in U.S. via an LLC. Now, again, the court did not address partnerships, but if we draw the analogy, the LLC for capital gains, purposes, the court said that the partnership the partnership is deemed a separate entity from the assets below. Okay? So when a person, if that is true for estate tax, then the person who dies is owning not real estate, but an intangible, that partnership interest. Okay? Now, FIRPTA does not apply here because FIRPTA only deals with capital gains events. Estate tax, for estate tax purposes, if a person dies owning a partnership interest, and that partnership interest for estate tax purposes is deemed an intangible, like it was for the Grecian case, then there should not be estate tax for the foreigner holding that interest, okay? Because again, what about FIRPTA? FIRPTA is irrelevant because that exception that we talked about, FIRPTA in general only deals with capital gains upon the sale of the asset, and the death is not a sale, okay? So while the tax court ruled the way it did on capital gains, it did not rule on estate tax, but here is where you and I together can bring people in your country significant benefit, and to address and their concerns about estate tax for these investments, both for shares of securities and for estate tax. Lots can be done to minimize, based on this ruling and other issues, to minimize the estate tax exposure of people who are investing in your country by way of partnership, or even if they've already bought in their own name, certain things can be done to get that stuff out of their own name without a tax event, and get it out of their own name into something which eliminates the tax. So, and as I said at the very beginning, these things can only be done in close cooperation between you and I. I can solve the U.S. tax issues, and they're complex, but I cannot solve the local tax, and I cannot even try to solve the problems of an Israeli living here without people from across the hall. We have a big department of Israeli tax lawyers. If I try to solve it and ignore Israeli law when they're living in Israel, I've done them a major disfavor. So these kind of solutions are only available if you and I cooperate, okay? Okay. This is the last slide before the test case. And so what about other sources of income? As I said, the court said that income tax you pay in America. Capital gains, it depends on if the business is regular carrying on the activity which brought on the gain. But what about other kinds? Let's say, as I said, I'm a VC partner located in Israel or Germany, or I'm involved in stocks. I'm a stockbroker and I have an office in America, and I'm wheeling and doing what I do, making income. But I also get a lot of bonuses. I get a year-end bonus, and I get, if it's in the VC world, when a startup of mine goes public, and I make a very nice amount of promote or promote. Is that taxable in America? So I don't want to go on at length, but the question comes down to the same thing. We're talking about if there is a PE, so we're talking about the last bullet. There is a PE. I have an office in America, okay? I'm based in London, but I have an office in America. And my business is, it can be buying and selling shares, it can be a lawyer, it can be a VC. And the question is, when I get that huge bonus at the end of the year, can the US come and say, yes, you're going to pay taxes on that bonus? So if the services are provided outside the United States, I'm looking at the last bullet, US will impose a tax, and this is from the tax treaty, the Israel-America tax treaty, but it's probably very similar to your own. It'll tax it if the US office is a material factor of the production of the income, and the U.S. office regularly carries on the activity, the type of which is generated by the income. So actually, as you see, it's very similar to the treaty language, is very similar to the court language, and it's all going to be a question of what kind of money that person, what the person made that bonus for, what is the goal of that bonus. If the person is living in England, but he has clients in Germany and France, and most of that profit is unrelated to the United States, even though there's some help from the United States, no. But if that person goes to the America lot or uses a lot of the infrastructure of the partnership, like the selling of stocks and bonds, then there's a bigger question. So a lot has to do with how you and I cooperate on how that contract between the partner you have in front of you and the contract between that partner and the partnership in America. How is that person's employment contract drafted? Because if it's drafted in such a way where it's clear that the person is basically just a small figure in this big U.S. partnership or company, then obviously that person is going to pay tax in the United States on that bonus. But if you're smart enough and you define that bonus as for something that's unrelated to the business of the American entity, then you're in a much better situation. Okay? So that is basically how I would propose to address issues of promote and profits and salaries, not salary, yeah, for people as opposed to capital gains and estate tax. I see that a wide variety of you, almost everybody is still there. Okay, a PE. A PE is a permanent establishment, meaning an office. It's a term used under the treaty. If you look under the treaty between the United States and UK or wherever, the term is a permanent establishment. A British person who's engaged in a business will only be taxed in the United States if that person has a permanent establishment, an office, a branch, things like that. Okay? Okay, the last issue, and I don't know really if this is a good time to go into it, this is the case study. It's a bit lengthy. What I'll do is I'll stop the recording for 1 minute. I'll let you read this because I don't think it would be all that effective if I read it, and then we can analyze it. So we'll stop the recording for 1 minute, and then we'll continue with an analysis for those that, for the bulk of you who are still online. Okay, question, just some brief questions. Yes, the presentation will be forwarded. Peter, you asked, capital gains from the sale of stocks is activity by I suggest, Peter, either, I didn't quite understand the question, you can either resubmit it or send me an email. Just so you know, this is before we continue, this is my contact information. You can contact me there. There's a wide variety of articles and publications available on my personal website. You can read all about U.S. tax and matters relating to foreigners and U.S. tax there, and you can contact me at LinkedIn. Again, this presentation will be submitted will be sent to you. Okay, so going back to this. So obviously, and I put in English because I wanted to English person, not an Israeli, because I want to show how this is generally available. What I'm talking about has nothing to do with whether you're an Israeli, Singaporean, Russian, or anybody else. Okay, so what I'm saying and what I've talked about up until now is the same for everybody, not for non-Americans. Okay, so here we have a British guy who has a UK company, which checks the box, and that person invested $10 million for a 5% interest in a partnership in Panama, and that partnership is active in drilling and exploration, and the UK company itself doesn't have any presence. Okay, they have buildings, they have heavy equipment, this partnership, they have some land, some of it's active and where there's drilling and others are not active. Now Russia comes along, this Russia company, and buys the partnership interests for $1 billion, of which 100 million is allocated to the land and the offices. Okay, so how is that going to be taxed? Well, obviously, if you've read it, and then what we're talking about, first of all, is a U.S. business, which is a partnership, and you have a foreign partnership. Excuse me, a foreign partner who holds an interest in the LLC, and that person is a foreign partner. So, conceptually, what we're talking about is that this United Kingdom corporation or British corporation should not be taxed on the capital gains generally. Okay? Now, we have a little complication here, is that there's some real estate here. There's the building, and there's certain parcels of land that the Russian company bought. Okay, so that's the FIRPTA exception. So while in general the British person will not be subject to capital gains, he will be, Trevor will be subject to capital gains on the component which is the real estate. Okay, and I said that $100 million is allocated to that. 5% of that, $5 million, is allocated to Trevor. Do we know how much tax the person will pay? Well, assuming that the capital gains rate in America is 20%, we know that he's getting $5 million, that person's share, but we don't know how much, of the 10 million that they invested, how much of that was allocated to the real estate when they bought it. Okay, so if we knew that $1 million of the 10 million that Trevor paid was allocated to real estate, then $5 million minus $1 million is $4 million. That's the gain attributable to the real estate. Okay, and 20% capital gains is $800,000. So Trevor would only pay tax in America, capital gains tax under FIRPTA, on the gain of the real estate, which is $4 million, and 20% of that is $800,000. Of course, there's one wrinkle here, one complication, and that is the Russians aren't buying really land. They don't care about the land. They care about the oil under the ground. Okay, and part of that land and what's attributable land, the question is, was the oil or the natural gas under the ground included in that $100 million, or the $10 million, excuse me, the $100 million was attributable to real estate? That's a very good question. If it was real estate alone and not the oil, then what we talked about is attributable, is taxable. But if part of the 100 million is also the oil, then the answer is that that part, which is attributable to the oil, is not taxable in America, because FERPTA does not have to do with minerals. Okay, so this is sort of how the breakdown of the analysis would work. And finally, the much more sort of but very complex is number 2. Assuming that the land that the Russians didn't buy is put into a U.S. corporation and transferred to the partners. So now Trevor owns 5% of the corporation, which owns those parcels, and Trevor dies. What about estate tax? Okay, this is an intricate question because under U.S. law, as I said here, let's go back. U.S. estate tax applies to U.S. real estate, which is not the case. There's no real estate here. Trevor doesn't own real estate. Trevor owns a share of a corporation. Okay? But you see on the third bullet there, he owns shares of a U.S. corporation. And therefore, unfortunately, Trevor did not seek good tax advice because he is now owning, how much did we say, $5 million of real estate, 5% of, oh, excuse me, I think I'm mixing things up here. Whatever the value of that real estate, which the Russians didn't buy, he owns 5% of it. And he doesn't own the real estate, but he owns a U.S. corporation. That is very unfortunate because he could have planned things differently to avoid estate tax. Now, to go one level deeper, it is he who owns the real estate. It's not the corporation, his UK company. Even though the UK company does own it, and not him, he checked the box, meaning he elected for the company to be transparent. So he is attributable, therefore, to owning the shares directly. Yes. So as a result, he is deemed to own the U.S. shares. And regardless of what is in that company, the actual shares themselves, it could be bubble gum. It could be $1 million worth of bubble gum held in that company. He pays estate tax on that. So it's like a perfect example of how people that you know make significant investments, and these things are highly intricate on the U.S. side and on your side, and I'd be very happy if we could find a way to cooperate and help your clients address these issues that they have. As I said, I'm looking for ways to work with you on these matters. It can be not in person, or I'd be happy to establish a relationship and actually to come to the United States, France, or wherever, excuse me, to the UK, France, and put on these kind of seminars to draw in these kind of people that hopefully will come, and if we market it effectively, and we can both see new clients and generate business. Anyways, that's it for now. A lot of talking. Here again is the, oh, sorry about that. Here are my contact information.